In today's video, I'll be sharing my top 6 favorite ETFs that I like to invest in for monthly dividend payouts. I've curated this list of Canadian ETFs so that you have a balance between decent yields, low management fees with potential upside of growth as well. Whether you're looking for stable income or just building your portfolio, these ETFs are options that you can consider. But first, a quick heads up, if you're new to investing and don't have a brokerage account yet, let me share with you my 2 favorite platforms here in Canada, Wealthsimple and Questrade. Wealthsimple is great for beginners as it's really easy to use with 0 commission fees. For more experienced investors, Questrade offers more advanced tools and resources. Both are excellent options, and I dropped my link in the description box below for some sign up bonuses. Also, a quick disclaimer, while I am a CPA and a tax expert, this video is purely for informational purposes only and not financial advice. Please make sure that you always do your own research and consult with a financial advisor before investing your own money. Now that we got that out of the way, let's dive into my top 6 ETFs for monthly dividend payouts. And make sure that you stick around until the very end as I cover some really important investing hacks that can make a big difference in your portfolio. So let's get started.
So before we get started, I just wanted to say that these ETFs are all based mostly in Canada and they are paid out in Canadian dollars when it comes to dividend income. And the reason being is because a lot of Canadian companies actually pay pretty high dividend yields. And as a Canadian who is taking advantage of certain tax advantage accounts like the TFSA, investing in the Canadian market is actually quite advantageous for us. So we're going to get started right away with our first ETF, which is VDY, which stands for Vanguard FTSE Canadian High Dividend Yield Index ETF. To kind of get an idea of what this ETF is about, it gives us a quick overview that it measures the investment return of common stocks of Canadian companies that are characterized by high dividend yield. So we can see what this fund is mainly consists of. First of all, it tracks the performance of the FTSE Canada High Dividend Yield Index. It also focuses on Canadian large, mid, and small cap stocks diversified across all industries. And we can see what the portfolio is made out of here. There's about 56 stocks and market cap is 82 billion, mostly focused on large companies, about 89%. And we can see that 100% is in North America, more so Canada, 100% in Canada. And we can see that the largest stake is in financials of 56%. A lot of Canadian banks pay out high dividend yields, so that makes sense. And then energy and utilities, which are more steady and stable industries that have consistent cash flow and that often tend to pay out dividends to its shareholders. This is a big difference from our last video on growth ETFs that hardly pay out any dividends or very low dividends because the focus for those ETFs was mainly on the capital gains, so the appreciation of the stock price over time. The focus of today's video is mainly on the consistent monthly payouts that we receive, which might not necessarily relate to the market returns on the stock price, but we'll go over that in just a little bit. So these sort of dividend ETFs mainly focus on big blue chip companies that have consistent cash flow and that are able to pay out dividends to its shareholders. So you can see that the sector is quite different, where the growth ETFs are mostly focused on technology. For here, we see it's mostly focused on financials, energy, utilities, and telecommunication. Let's go over the price point. So here, as of September 27th, we can see the market price is about $48, which is very reasonable entry point. The management fee is a little bit higher at 0.2%, but still quite reasonable. And the 12-month yield is 4.49%. Now, there are a lot of other ETFs out there that providing really high yields. You may have to question yourself how that is affecting the stock price, because it's rarely the case where you can get both really high yields and also appreciation in the stock price. And while our primary focus is not on the appreciation of the stock price itself, we also want to avoid significant decline in the stock price, which we'll actually go over at the end of this video on certain ETFs or split funds to avoid. But I would say as a 12-month yield, this is pretty reasonable at 4.49%. And also you get a payout on a monthly monthly basis. We'll quickly go over the performance for this stock as well. As you can see here, the market price of this particular ETF has also done very well in addition to its dividend yields that it pays out. So you can see that the year to date is 13.49%, 1 year is 20.38%, 3 years 10.15%, and 5 year is 12.25%. So while this is not our primary focus on investing in dividend paying ETFs, this is a really nice bonus in addition to the dividend income that you're receiving. And that is why it's very important to look for really high quality ETFs that pay out dividends and that also have potential for some growth as well. Moving on to our next ETF, we have XEI, iShares S&P TSX Composite High Dividend Index ETF. Now, what this is composed of, we could take a look at its holdings, is also mainly to do with the financial sector. So 30% of it is in financials, 29.54% is in energy, utilities, communication, materials, real estate, consumer discretionary, etc. And you can see that some of its top holdings are banks or in the financial sector, like Toronto Dominion, which is TD Bank. There is also Canadian Natural Resources, TC Energy Corp, Suncor, Enbridge, we know pays out higher dividends, and etc. When it comes to the price point, it is a very reasonable entry point at $27.22. We can see that the management fee is slightly higher at 0.2%, and the distribution annual yield is 5.00%. And when it comes to the performance, we can see that in the past year, it has done well at 4.98%, 3 year is 8.77%, 5 year is 10.07%, and 10-year mark is 6%. So we can see that while this particular ETF provides a slightly higher dividend yield, the performance of the stock price is actually, FDI has done considerably better with better returns compared to XCI. So while the two seems quite similar in terms of the sector that it's invested in, there's still a difference when it comes to what specific underlying stocks that they've invested in that account for the different dividend yields as well as the total return. Our next ETF is called the Global X High Interest Savings ETF Cash. Now, I like to throw this in there for more of a low risk alternative when it comes to holding excess cash that you don't quite necessarily know where to put your money in. This is mainly to do with high interest savings accounts. I would say that you can expect to receive the higher end of interest rates here than in any high interest savings account through banks in Canada. There may be certain promotions within banks where the first 6 months you might receive 5%, but after the 6 months are over, it might go down to 3% or 2%. So maybe keep that in mind. But if you have money in your investment account and you don't know where to put it, then you can potentially park it in cash for the time being until you decide where to invest your money. So as you can see, when it comes to holdings, is mainly in banks like the National Bank, CIBC cash account, Scotiabank cash account, etc. When it comes to the price, it is about $50 and it stays within this range. It might go up and down a little bit, but usually the fluctuation isn't too bad. You can see that the last closing price was $50.14. So you don't really expect a huge fluctuation in this particular ETF. When it comes to annualized distribution yield, it is at 4.2%. This has definitely come down since the rate cuts by the Bank of Canada recently. We've had a couple of rate cuts now. This used to sit, above 5%, but it has definitely come down as it is correlated to the interest rates that banks offer. When it comes to fee, it is currently sitting at 0.1%. So that is usually the norm when it comes to investing in Canadian dollar. You don't really get the super low fees that comes with US based ETFs and stocks. So this is pretty low considering that this is Canadian based. And when it comes to annualized performance, you can see here that it wasn't created too long ago, so we don't have too much historical data, but in the past year, the return has been about 4.97%. I am not sure if this includes the dividend yield or maybe potentially the increase and decrease of the price of the stock itself. But there is definitely slight fluctuations in the price of the stock where, usually it is centered around $50, but it might go up a little bit based on market demand. So I just wanted to provide this as an alternative to receiving dividend income, but obviously there isn't much of a growth potential when it comes to the market price of this particular ETF. Our next ETF is called ZRE BMO Equal Weights REITs Index ETF. I want to also include some diversification to our current dividend ETF portfolio. We've mainly focused on the financial sector, the energy sector, and some cash, but this also provides additional diversification by investing in the real estate market. We can see what is made up of this particular ETF. 100% is based in Canada, so all Canadian real estate. You can see that there is a mixture of retail, multifamily, diversified, industrial, healthcare, office, and etc. And you can see that the top holdings are all made up of real estate investment trusts such as Alley Properties, Northwest Healthcare, First Capital, H&R, Granite, Crombie, Dream Industrial, etc. When it comes to the price point, the last closing market price it was $23.70, so very reasonable. When it comes to annualized distribution yield, it's about 4.55%. So that's your dividend rate, and you are getting paid on a monthly basis. The management fee here is a little bit higher at 0.61%. So it is on the higher end, and that is something to keep in mind. When it comes to performance, we can see that obviously this REIT ETF really depends on the real estate market in Canada. So in the past year, it's been about 12.89%. And then the past 2 years, 4.13%. Past 3 years, it's been a negative 1.59%. 5 years has been 2.92%. And 10-year has been 6.14%. And you can see here in the small font, it says past performance is not a guide to future performance. Performance is shown net of fees. So that's high fee that we just saw. This excludes that and in the currency of the respective share class with dividends reinvested. So this is assuming that dividends have been reinvested. So moving on to our last couple of ETFs. The next one that I have is the Hamilton Enhanced Multi-Sector Covered Call ETF. So this one is a little bit more risk taking. It is using a strategy called covered call. And the goal here is by taking on a bit more risk to provide a higher yield and higher return. Let's see what this ETF is mainly made out of. We can see that it's mainly focused on the financial sector by 34%, utilities by 15%, and healthcare of 8%, and a bit of technology, a bit of gold and energy and REITs as well. So it is quite well diversified, but as you are aware by now, with the Canadian market, we receive a lot of the dividend from the financial sector. When it comes to pricing, the current price, well, if this is the net asset value, is $17.51, so very reasonable entry point. However, the yield, as we've seen so far, is one of the highest at 12.08%. So as you can see that the current annualized yield here is 12.08%. The distributions are received on a monthly basis, and the management fee here, it says it's 0%, but that is because it holds underlying ETFs that in itself pays out management fees. So this is to kind of avoid double layers of management fees. For example, when you look at the holdings, it's invested in multiple Hamilton ETFs, such as the Hamilton Enhanced Canadian Financials, Hamilton Technology Yield, Hamilton Energy Yield. So it's invested in all these different ETFs, which in itself pays management fees. And I believe those are on the higher end as well at 0.65%. But for this particular ETF, it's 0%. So this particular ETF doesn't give a good depiction of the price and how it has performed over time. It does give here an example of how it has outperformed the S&P TSX 60. It has outperformed it. You can see even the yield is quite a bit higher, and that is because you're taking on higher risk because of the covered call strategy. But when the market doesn't do so well, it might take a bigger hit as well. When it comes to the price, you can see that there is quite a bit of fluctuation, but the range isn't that great. You can see the highest point being $18.81 and the lowest point being $14.27. So if you bought it during this time, there has also been quite a bit of appreciation of about 21%, it seems. But if you purchase it back here, you would be experiencing a decline in the price of your stock. But as I mentioned, the main primary focus for these dividend ETFs is more for the monthly consistent payout. And as long as the drop in price isn't too significant and the fluctuations aren't too great, where you're down, 20, 30, 40, 50%, that you can see over time, there might be some growth potential, but mostly you want to maintain the price point. Moving on to our last stock, we'll be covering Hamilton Canadian Financials Yield Maximizer ETF, which has a ticker symbol HMAX. We can see the sector allocation here where it is mainly banks, so 73.1% bank. There's a bit of asset management and the rest goes to insurance. So it's a little bit different from HDIV, which we just went over, but mainly the bank portion is largely the same. We can see the net asset value here is $14.56. The yield right now is 14.45%, so a little bit higher than HDIV. So here you can see that the current annual yield is 14.45%. The target yield is to be more than 13%. The distributions are done on a monthly basis, and the management fee here is 0.65%. And that's because this is the ETF that directly holds the stocks in its ETF, like Royal Bank of Canada, TD, Brookfield, Bank of Nova Scotia, Bank of Montreal, etc. So something to keep in mind for this is that it is using a covered call strategy, and it actually gives a bit of a description here where many covered call ETFs write options on 30 to 50% of portfolios out of the money. HMAX is able to provide higher monthly income with a dynamic covered call strategy, currently writing options on 50% of the portfolio at the money. This allows HMAX to generate higher options premiums while maintaining 50% upside potential. So with this one, you can see that something also to consider on top of the covered call strategy is to see if they're also using leverage. Here it explicitly says that HMAX does not use leverage. Something that I didn't go over for HDIV is that HDIV does use leverage. They use a modest cash leverage of 25% to enhance yield and growth potential. So this would explain the fluctuation in the stock price. For HMAX, you can see here that the stock price doesn't fluctuate too greatly other than back here in 2023. But other than that, the range of the fluctuation isn't too great, where the low is $12.54 and the high is $14.62. Obviously, if you purchase it somewhere around here, you can be experiencing some appreciation, but if you purchase it back here, then you would be in the negative. So you have to consider if that's worth it when it comes to the dividend yield that you're receiving of 14.45%. Lastly, I wanted to go over a split fund. So something to avoid is a split fund like FTN. As you can see here, that the dividend yield is 18.06%. So that might seem very enticing, but something that you might not consider is one, how leveraged the split fund is. So how much debt it has to take on, and also what sort of other riskier strategies is using, like covered calls and etc. With split funds, you can see in this case that there has been a significant drop in the price of its stock. So you can see if you were to see the peak back in 2020 to now, there has been a drop of more than 53%. So even if you're receiving an 18% dividend, and note that the 18% is on the current price of $8, not the price that you purchased it in, which is about $18 back here, you would be experiencing a loss of more than 50% on the value of the stock that you purchase. So something to consider are these split funds where it might seem very lucrative, but there is always a downside to them. And to always keep in mind, if something sounds too good to be true, then usually it may be. So just wanted to put it out there. Now that we've covered all the dividend ETFs, we'll now be moving on to top tips that will really set your investment portfolio apart. So make sure that you watch until the very end.
Key takeaways here: VDY.to and XEI.to offer the best balance between dividend yields and low fees. Cash.to is a great choice for liquidity and stability while earning competitive interest income. ZRE.to provides stable income payouts from real estate sector, although with slightly higher fees. And HDIF.to and HMAX.to provide higher dividend yields with covered call strategies, though they do have higher fees and less capital appreciation potential. Now, some important investing tips. First is to keep it simple. Try to limit your portfolio to only 5 to 10 ETFs for diversification without overcomplicating things. I've made this mistake of investing in a whole bunch of stocks and ETFs, and it just made things a lot more complicated than it should be, with the returns not really showing for it. The second tip is to set it and forget it. So consider using dollar cost averaging to steadily build your position over time. Another tip is a cash strategy where you keep some of your excess cash in low risk options like cash.to, and then when the market dips, use that cash to buy stocks on sale. Another tip is to minimize or avoid split funds. While high yield split funds that pay out 15 to 20% dividend yields may seem attractive, they often come with significant risk. The stock value tends to fluctuate a lot, and over time, the decline in stock price can often outweigh the benefit of the high yield. For instance, split funds like FTN might offer enticing payouts, but the potential devaluation of the stock can severely impact your overall return. So if it sounds too good to be true, it likely is. Another thing to consider is risk versus reward. High yield ETFs may come with higher risk and more volatility in price. So decide whether you prefer higher yields with fluctuating stock prices or steady yields with gradual price increases. I've provided 2 ETFs, HDIV and HMAX, that provide higher yields, but note that they are also higher risk because of the covered call strategy. And with HDIV having slight cash leverage of 25%, while HMAX does not use cash leverage at all. Another tip is to invest in your TFSA. Invest in Canadian stocks within your TFSA for tax-free dividend income. This way, your monthly payouts accumulate tax-free. And also, if you need that dividend income, you could actually pull it from your TFSA tax-free. If you don't need the cash, then you could set up a DRIP, which stands for Dividend Reinvestment Plan, to automatically reinvest your dividends every month without you even thinking about it. Another tip is investing in US dividend paying stocks in your TFSA may result in withholding tax. Watch my other video here on growth ETFs for more on this. You may also have noticed that my dividend portfolio is heavily focused on the Canadian market within my TFSA. That is because my growth portfolio is almost entirely focused on the US and international market, which I like to invest in my RRSP. If you want to know why I structured my portfolio this way and you're curious about the top growth ETFs that I like to invest in, make sure that you check out my video over here. Thanks so much for watching today, and I'll see you guys in my next one. Bye!